In this video, I'll be running through how to break down the unit economics of your store. We'll be going through the core levers as to how you can improve profitability, as well as what is unit economics, and then how can you do this analysis and apply next steps to immediately get better financial outcomes through your paid media efforts. So what we're looking at here is a cart broken down into the underlying unit economics. And this is the first thing to understand with unit economics, is that within the context of e-commerce, you're generally not actually looking at the unit level. You're normally going to look at the cart level. And the reason for that is it just doesn't make sense to look at a unit level when you have 3 to 4 units on average within a cart, and then there's a shipping cost and a discount rate associated with that cart value. It just doesn't really make sense to do an analysis at a unit level. So when we're talking about unit economics, we're really talking about the basket or cart economics. So what is the average cart that you have within your business? And I'm going to show you what that actually looks like in a moment and the core metrics to be looking at. And then how does that break down into profit contribution at an individual cart level or an individual order level? And so up the top here, we're starting with just order volume. And so this is a real business, and these are the real numbers that they did last month. So they had 2,062 first-time orders, 836 returning orders, a total of a little bit under 3,000. And we're splitting the unit economics of first-time and returning out. We're separating them because it's really important to understand the dynamics in isolation. You'll see why this is so important as we start to work our way through these different line items. So where unit economics begins is at average unit retail and units per transaction. So average unit retail is quite self-explanatory. It's the average retail price of a unit within the cart. And so if you're selling 5 t-shirts and they're all $50 a t-shirt, your average unit retail is $50 and your units per transaction is 5. And so another example, if you're selling 2 t-shirts at $20, that's a $20 average unit retail, 2 units per transaction. So we've taken the averages here of all of their order data, which is relatively easy to do simply through Shopify exports and manipulating the data. In fact, you can actually pretty much get these numbers just natively within Shopify reports these days. Now from there, we're calculating gross retail. Gross retail is not average order value. It's not average customer value. It is average unit retail times units per transaction. Now, it's important to understand gross retail because this is essentially your effective pricing before you start to layer in discounts, returns, and then also add shipping collected that is collected at checkout. So we go and then we calculate the discount rate. And so this is the average discount by coupon code taken within Shopify. Now, it'd be really ideal to have discount rate inclusive of markdowns. That capability just doesn't exist within Shopify at the moment. It's very difficult to actually store that kind of data in a database and run the math. And so this is just strictly discount codes being applied. Now you can see this brand actually discounts quite heavily. The next one we have is return rates. This is really commonly not considered within your unit or your basket economics, but it should be because you have a relatively fixed return rate that could be improved or could get worse over time that needs to be considered in the profit contribution calculation at a unit level. What ends up happening if you don't include this, particularly if you're in fashion and you have 5 to 15% return rates, which is pretty typical, is that you'll run your unit ec, it'll look profitable, but there won't be a consideration of the really high return rates that actually take it as zero or negative profit. So it's really important to have this included. The next is your average shipping collected at checkout. The reason why we separate this is, number one, Shopify actually doesn't include this in their average order value number. And so you'll see the average order value number that I'm calculating here will actually be significantly higher than Shopify's number because it includes shipping collected, which it obviously should, because that is cash collected at checkout that gets paid out to you. And then number two is that there is a psychological weighting towards collecting shipping versus price of product. And so segmentation of value here is important. People are going to place the $46 of value onto the t-shirt that they're buying. They're not going to place the $13 of shipping onto the value of the product. This is instead value associated with the ease of consumption, pretty much, is that I'm willing to pay $13 to not have to go down to the store and buy a t-shirt and just buy it online. That's the value association that I'm making as a consumer. And that's reasonable, okay? Uber Eats is like $5 to $6 a t-shirt. I'm buying a lot of stuff. Yeah, okay, I'm probably willing to pay $13. You bump that up to $60, I'm not willing to pay it. But if you take that incremental $45 and you reallocate it into the price of the product, I'm all of a sudden willing to pay it because I associate that increase in pricing with increasing quality of product rather than in the just method of shipping and the ease of essentially the time it's going to save for me to actually go down and buy the product. So it's really important to segment these things because they need to be treated differently and they're different levers. From there, we can calculate average customer value. Now you can see the formula here. This is gross retail times 1 plus discount rate. So we're just taking the discounted dollar value off to see, okay, what does our essentially average order value look like? Because this will be exactly what the average order value number tells you within Shopify. From there, we want to also remove the return rate and we want to add in shipping collected. And so this is really your true average order value, a much better measure than what you're given in Shopify. From here, we move into our cost of delivery section. And so we have cost of goods at $37.43. We then have cost of delivery. This is our shipping and fulfillment and 3PL associated costs. And then we have cost of transaction, one that is missed by most people as well. So making sure to include that. From there, we have a gross profit calculation at a average cart level. Okay, we can call it a unit level, but technically it's not because there's 3.36 units in the average cart here. That takes us to a gross margin of 56.77%. Now, the next consideration is what is our blended CAC? This is our total advertising cost divided by new customers acquired. That sits at $58.75, which then takes us down to the final calculation here of profit contribution, which is your gross profit minus your CAC, which comes out to $16.76, which sits at a CM3 percentage or a contribution margin percentage of 12.61%. Now, this number right here is really important for majority of brands, and it's something that people need to understand better and consider. Why is it so important? If you don't have incredibly high returning customer rates, if returning customers aren't driving a lot of revenue for you as a business, let's say it's sub 15% of daily or monthly revenue, this contribution margin figure is pretty much your indicative of your ability to operate net profit percentage. This is your upper bound, effectively. And so what I mean by that is that if you're only ending up with 12.61%, and then we go and add in operating expenses, and let's say you have $10,000 of operating expenses, what you can technically do, I don't like this at all because operating expenses are fixed and shouldn't scale proportionate to volume, and therefore this is a poor exercise, but you can do it. I see people do it all the time. You can take your operating expenses, you can divide by the amount of orders you have, and you'll get effectively an operating expense at a unit level. So how much are your salaries, your warehousing, your software costing you effectively per order? And you can see that this, in this case, is $4.84. And so we can go and then put that in here and we can go $4.84. And then we can technically go and get a net profit at an individual order level calculation. And so we would just do this by going profit contribution minus OPEX, which comes out at $11. The reason why this percentage number is so important is because if you had $0 in OPEX, which is obviously impossible, but let's say you did, your maximum profit that you could sit at net would be 12.61%. Now, realistically, you're probably going to have 10% operating expenses if you're honestly really lean at a size of this brand. And so your current maximum net profit is 2%, which means one of two things. Either number one, you need to significantly improve your acquisition strategy if you want to actually be profitable, or number two, you need to significantly ramp up your ability to get returning customers so that you can make money in returning customers, and that will improve your ability to operate at a net profit that makes sense. And so that leads really nicely into the second column here, which is the returning customers. And so what you'll end up seeing with returning customers, or what you should always end up saying, is that you should have higher gross retail. The reason why you should have higher gross retail is because if a customer has bought from you before and they are returning to buy again, they should have increased consumer confidence. They have purchased your product before, they've gone through the shipping and delivery process, the customer support. They've probably, if it's clothing, they've worn your product, they've used it, they've consumed it. They should come back and have higher purchasing power. They should be more confident in allocating dollars to your business versus another. In this case, they don't. So really interesting. Average unit retail is slightly lower, units per transaction slightly lower, and so gross retail sits slightly lower. Fascinating. Now, this is probably an issue with their current retention strategy. They're probably just driving people to lower value offerings when they should be driving people to higher value offerings. Or it might be an issue with their product portfolio. And so when people go and buy first time, they have an ability to, let's say they only sell one particular t-shirt, a pair of shorts, and maybe some hats. And they're selling that as a bundle for first purchase. And so that's how they're ending up with a really strong average order value on first purchase. But then after that, to get repeat purchases, that's all they have. And so the only way that they can really get people back is to buy the same stuff again. People aren't going to want to buy all three. Maybe they buy one or two in a different color SKU. And even then, like, do I really need more of this product? And so to do so, they have to discount really heavily. And so that's what you see here. Returning customers are getting discounted at 42% versus 22%. Now, that ends up becoming an issue when we start to move our way through and we get to average order value. Average order value is sitting about 40%, maybe 50% lower here. Now we move through to cost of goods, and you can see cost of goods is the same. And this is what happens when you discount, is that your cost of goods stays the same. You just lose a bunch of margin. And so you go down to gross margin, and they're operating at 38% gross margin on returning customers. Now, luckily with returning customers, there's no direct marketing expense associated with getting that customer back. And so you end up with that flowing straight through into profit contribution, and you end up in a better position than you do on first-time orders. And so right away, we can identify an issue with the returning customer strategy and the product portfolio strategy here, which is that, yes, they're able to generate returning customers, but they have to do it at a significantly lower gross profit, half the gross profit of a new customer, which is having a significant impact on profitability. What we can do here is we can calculate their profit by going to profit contribution on first-time orders times by first-time customers, go returning customer orders times profit contribution on returning customers. And I realized you can't see this at the moment, so let me move these calculations over to here. And so on first-time customers, they're making $34,000 in profit contribution. On returning customers, they're making $29,000 in profit contribution. And this ends up being a similar trend for most brands, which is that despite returning customers doing 1/3 of the volume and having significantly worse gross profit, you actually make almost more money on returning customers. In most cases, you do make more money on returning customers because there's no advertising cost associated with them. Now, what if the returning customer or the retention strategy was fixed to where we could maintain the same volume and not need a discount by 42%? What if we only needed to discount by what we're doing on acquisition? Okay, what if we just matched acquisition at 22% discounting? Well, what then ends up happening is gross profit jumps to $63. And you can see there, returning customer profit contribution just jumped to $52,000 from $29,000. And so that is a $23,000 jump in profit per month. This is at a monthly level, just by fixing the discount rate within this business. And that's why starting to understand the levers that underlie unit economics becomes important. So let's dive into those levers. Starting at the very top, the most effective lever to change profit down the bottom here, out of average unit retail and units per transaction, is units per transaction. It makes a substantially bigger impact than average unit retail. And that's why people spend so much time talking about upsells in cart, cross-sells in cart, bundling, all of these different options, rather than just increasing prices. Now, increasing prices is a really effective way to just add profit straight to the bottom line, right? If we take the price here and we just bump it by $5, and so they effectively do a $5 bump on all their products. If you watch the profit contribution number down here, they go from $16 to $28. So you effectively double the profit of the business just by increasing the unit price by $5. But what if we increase units per transaction? Right now they're sitting at 3.36. Can we push this up to a 4? And by the way, these guys already do an incredible job of this. And so no, they probably can't increase units per transaction any further. But let's assume this was a brand that was doing a bad job. And in fact, let's turn this into a brand that's doing a bad job. Let's take this down to 1.7. So at 1.7, this brand would be losing $42 on acquisition. And so their units per transaction is one of the things that's actually saving them at the moment, how effectively they can push people to buy so many products in one cart. Let's go the other way. Let's go from 3.3 to 4. Once again, watch the number down the bottom here. It goes from 16 and it jumps up to 40. And so you can see that we could increase prices by $5, or we could just convince everyone to put 0.5 more of an item into their cart, and profit contribution goes through the roof. Now, to be fair, cost of goods wasn't changed accordingly for that increase. And so take it with a grain of salt. This is probably increasing closer to 35, maybe 32, but still obviously a doubling in profit contribution by increasing units per transaction. And so this is your really number one lever at the top here to make a substantial impact on the profitability of the business. Now, as we move down, number 2 ends up being discount rates. And obviously, it's not to say that everything else here doesn't make an impact. Obviously, it does. But when we're talking about really big needle movers that are going to wildly swing around unit economics, these are the ones to look at. Discount rates. Now, for a lot of brands, you'll look here and there'll actually be nothing you can do because discount rates are at 5 to 10%, which is pretty standard, and you're in a good position. Okay, that just means that you're running some abandoned cart flows with discount codes. There might be a few discount codes lingering around on the internet as well that people are scooping up. And then you're probably just discounting grade C product. Makes complete sense. Here, this is a little bit aggressive. In fact, this is very aggressive and actually a point of a lot of leverage. Because if they stopped discounting so heavily on acquisition and they took this down to just 5%, once again, look at this number down here, $16 jumps to $43. Right, so they almost double, they do double the profitability of the business by just taking their discount rate down from 20% to 5%. Now, easier said than done. You could make an argument that discount rate is most often set by supply and demand. And so if demand was higher for this business and the products, they would be able to reduce their discount rates. But I made a solid argument to this business owner, and I will say this publicly as well, that they actually just didn't have enough creative velocity to be able to sustain efficiency levels, which led them into this spiral of discounting. And so they are under the belief that they need to discount heavily to be able to generate demand. But in reality, they can just generate more demand by increasing creative velocity and fixing some account structural issues within the meta account. And so even though, yes, if you're a big brand, you're doing all the right things, high creative velocity, account structures in place, you have data integrity in place, you're connecting things to the P&L. Okay, discount rate is probably going to be set by the market to a degree. And the general consumer sentiment at the time. But if you're not ticking all those boxes, then yeah, we can definitely make strides in discount rates. Next one is return rates. This isn't going to be huge for most brands. This is very rarely going to be a big lever. For some brands, it is. 1 in 40 that I look at, return rates are an opportunity, but most it isn't. This is a minor lever, but I'm going to flag it here anyway, which is shipping collected. Most people don't collect the correct amount of shipping. A general rule here is that you should collect 10% of whatever your gross retail is, or more specifically, whatever your average customer value is. And so this brand is pretty much collecting spot on what they should be. And so this isn't a lever for them at all. They shouldn't increase or decrease shipping collected. They're right at the correct spot. It is also dependent on the consumer's view of the product. And so if this brand does sell kind of bulky products, and so I could see them effectively getting an extra $2 to $3 here and it not impacting conversion rates at all and being completely incremental in terms of profit, because I could see consumers viewing it as substantiating that it's a relatively big product, so it's hard to ship and it might cost a bit more. But for most businesses, 10%, and then you move on. The next one here is going to be COGS. So cost of delivery, you don't have much leverage here, generally speaking. Now, obviously, you can always improve these things by 5 to 10%. And if you go through this full funnel and improve everything here by 10%, you'll double the profitability of the business. But for most people, cost of delivery, they are only going to push it by 5 to 10%. Cost of transaction, there's probably nothing you can do here. For most brands, for some brands there is, right? If you're on Shopify markets and you're doing a lot of volume internationally, you can switch to having separate Shopify stores and getting paid out in your local currency. And that's going to save you a lot on international transaction fees. And you're actually probably going to be able to bring this number down by a few dollars, which compounds at volume. And so, yeah, it's not to say that there isn't value here, but for most people, lever 3 sits at cost of goods. And so this is obviously, as you achieve scale, can you drive cost of goods down? Now, more important to this is that we're looking at averages across the unit economics of the store. This business has over 30 to 40 different unique products. And then on top of that, probably 150 to 200 unique SKUs. And so what that ends up meaning is that, yes, you might be immediately thinking, okay, this comes negotiation with suppliers and just increasing MOQs so we can drive our COGS down. Yeah, absolutely. But you could actually fix this COGS issue without doing any of that. You just need to look at the product portfolio, what products have the highest gross margin, and sell more of them. And then your average cost of goods at a unit level will go down. And so you probably have, you can take all your products, you can look at net sales over the last 12 months. You can then segment that down into deciles. You can look at decile 1 products only. And then of those decile 1 products, you can look at gross margin. And then you can just prioritize the decile 1 products that have high gross margin, and you can improve this number. And that actually becomes a big lever for a lot of businesses, particularly those that are retailing other products and then also manufacturing their own. Just a switch in focus, creative focus, as well as budget allocation to high gross margin products is going to become a lever here. You drive this down by $5, drop straight to the bottom line. Profit of this business improves by 33% overnight. Then we get down to gross profit. And then we get down to direct marketing. And so this is ultimately lever number 4 and why marketing is so important. Because obviously if this business's CAC dropped by $10 and they got it down to 48, once again, profit of the business doubles. And so we can have an exercise here where we go through and just improve all of these numbers by 10%. And so that if they did a slight, and once again, let's anchor this over here so you know the starting spot, which is $16. But if they did a slight price increase, very, very slight, $2 to $3. So let's take this to 48. They slightly improved their units per transaction. Once again, 5%. Let's take this to 3.45. Their discount rates improved slightly from 22%. Maybe they got them down to 17 or 18. Return rate stayed stable. Shipping collected, as I said before, they could probably collect another $1. So let's put on 50 cents here. Now, COGS have gone up a little bit because they're selling a little bit more. So we're actually going to layer in a little bit of an increase here. Cost of delivery is probably going to maintain pretty stable. The increased units per transaction here is actually light products that can fit into existing packaging. And so you won't see much of an incremental lift here. Cost of transaction is going to go up slightly due to the increased average order value. And then marketing drops once again slightly, let's call it 10%. And so we get a $5 reduction here. Let's do less, let's say 5% improvement. So this comes down to $53. And well, now the business is sitting at $34 in profit contribution per unit compared to $16 where we started. So effectively doubled the profitability of the business by a few dollar increases in price, a little bit of an improvement in our ability to have our customers put more items in cart. We dialed in our discounting strategy by a tiny bit. We collected $1 extra of shipping at checkout. And then we improved our marketing efficiency by 5%. And then through those just tiny changes at each level of unit ec, it compounded down to $34 in profit contribution. And as a reminder, they were doing about $29,000 in profit contribution on the first-time customer P&L. And so you double that, they're now at $60,000 a month. And now you go and obviously fix the discount rate over here, and this is doing $40,000 a month. And now this business is doing $100K in profit contribution per month, as opposed to what they're currently doing, which is closer to 35 to 40. And so this is ultimately why understanding unit economics is so important, particularly being able to break this down for your particular business. We obviously have the ability to do this for clients. So if you want us to break these numbers down for you and give you a roadmap on how to improve these levers, reach out to us. If you're doing this in-house or if you're an agency as well, I strongly recommend getting an understanding for these levers and really trying to work with them, trying to improve them with your clients, because it compounds at the bottom and really changes the profit position of a business.